Hey guys, Kevin Burgess back yet again with another video. It's been a couple of weeks since I've made a video and I have missed you guys a lot. I'm glad to be back in the saddle again. My schedule has been crazy busy. I don't know who told me that retirement was not going to be busy, but they were absolutely wrong. But I'm glad to be back. I'm looking forward to this video. I've got some cool stuff to share with you. I have added 3 new positions to my portfolio as of Friday. I have added to 4 positions in my portfolio, and I have eliminated 1 position from my portfolio. If you want to see all about that, stay tuned. Hey guys, I'm excited to be back with you again this week. I am really pumped about what I've done in the portfolio on Friday. As you recall, Friday was a really red day. As a matter of fact, let's take a look at some of that. So take a look at this. Look at all of the red. There's only just a tiny bit of green here. It looks like it's Electronic Arts, and there's something down here that's green, which is Molina Healthcare. I have no idea who that is. Maybe a little bit of green down here for CF Industries Holdings. But other than that, it looks to be really red. And even looking at the 1 week performance, you can see that the market was pretty much red, except for the energy segment over here. It's got some green, but everything else was red. So I decided to take advantage of that red and reposition some things in my portfolio and go ahead and spend some of the cash that I've been sitting on and buy some stocks. So I want to share with you today what stocks I bought, what stocks I sold, and what stocks I added to. I'm also going to give you an update on the portfolio's performance as of August the 19th as well as August the 26th. Since I didn't do a video last week, I'm going to give you both weeks this week. It's important for me that I am totally transparent with you. I'm going to tell you what stocks I've bought, what stocks I've sold, what my portfolio looks like, what the performance is on a weekly basis. And I do this totally free of charge. I don't have a Patreon. I mean, all of this is free to you. And hopefully this helps you if you're either new to investing or you're trying to build some skills in investing. Hopefully this amount of detail and this amount of transparency will help you along your journey. And some would say that you're not paying anything for this, it's free, and it's probably worth what you're paying for it. But either way, if you like the content, if you'd give me a thumbs up on the video, I would appreciate it. It lets other people know that there's good content in here. And also, if you want to subscribe to the channel and go along this journey with me, I would be glad to have you. Look forward to it. And with that, let's get started. So let's take a look at the performance of the portfolio for August the 19th. You'll see that for that week, overall, and I won't go through this in detail, but overall, the portfolio was down about 0.2%. The S&P 500 was down 1.2%, which means we did 1% better than the market, but we still lost 0.2%. And then down below, you'll see year to date that the portfolio was actually positive by 0.9%. And the S&P 500 was down year-to-date 11.8%. And if you'll recall, I added this other bit of information in here last time I did a video, and it shows the percentage of dividends and options that I have collected, and divides that by the portfolio value to give us the fact that the portfolio also earned 2.1% year-to-date in dividends, so a total return of 3%. Not too shabby in this kind of market when the S&P is down by about 12%. Now let's move on then to August the 26th. You'll see that the portfolio was down 3.2%. That was down $29,000 roughly in market value. I got no dividends this week, other than I got 93 cents of dividends from Starbucks in the dividend snowball account. And guys, I don't know why, but I am really excited about that 93 cents. It's the first dividend in this dividend snowball account. I'm really excited about that. I think what I'm going to call it is a dividend snowflake for the snowball. So for the week, we see that the portfolio was down 3.2%. The S&P 500 was down 4%. And on a year-to-date basis, then the portfolio is down now 2.6%. We are, in comparison to the S&P 500, being down 15.4%. So we're still, doing pretty well. We're still beating the S&P 500 by about 13%. If you take the dividend and options return, we didn't get any this week, so the percentage stays the same. And that's 2.1%. That means we're down in total return about 0.6%. So it could be a lot worse. So I think the portfolio has held up very well during this time of bear market and uncertainty. So that's enough of that. Let's move on. I want to share with you the stocks that I've added to the portfolio, the new positions that I have this week. They are, I believe, going to add a lot of quality to the portfolio. I'm looking forward to that. These are starting positions. These are not like full positions, but I am going to add more as time goes along to these positions. But I want to share some details with you, and I'm going to do that using my two favorite apps. My two favorite apps are Fast Graphs and Simply Safe Dividends. So I'm going to use both of those to kind of share with you what I've added to the portfolio. So let's get to it. Okay, the first stock is the video I made a couple of weeks ago, Robert Half International. I have decided to go ahead and start a position in Robert Half International, ticker symbol RHI. You can see that it is definitely in the buy range. And this is from Mr. Income. I know you want to be at a lower price than I am on anything that I buy. So just to let you know, my opening price here is $78.44. I did that on Friday. So, hopefully you'll get a chance to beat that price. A little bit of detail around Robert Half. Let's go to Simply Safe Dividends. You can see here that RHI, Robert Half International, has got a dividend safety score of 96. It's very safe in terms of dividends. They have a dividend yield of 2.21%. Robert Half International provides staffing and risk consulting services in North America, South America, Europe, Asia, and Australia. It's got three segments. It's got the temp staffing segment, the permanent placement segment, and a risk consulting and internal audit services segment. Let's take a look at their dividend growth stats, and it looks pretty consistent. If you look at the last year, they grew their dividend by 13%. In the last 5 years, they've averaged 12%. In the last 10 years, they've averaged 11%. So they have definitely been consistent, as you can tell, in growing their dividend. They have paid a dividend for the last 17 years uninterrupted and have grown it for the last 17 years. So that's pretty impressive. Let's take a look at some of their financial information. The earnings payout ratio is where I like it, down in the 26-28% range. They struggled a bit, and you'll see it in the earnings in the year of COVID, which is 2020. That's quite understandable. I don't have any issues with that. But the earnings payout ratio is very nice, as well as the free cash flow payout ratio. Let's look at shares outstanding. They have gone from 139 million down to 111 million over the last 10 years. And this is really impressive, guys. Return on invested capital. That means that this is the return they get on the dollars of capital that they have invested in equipment and things like that. It's 58% over the last 12 months. That is stellar. I look for anything that's going to return more return on invested capital than the cost of capital. This is blowing that out of the water. So I'm excited to have that level of return on invested capital in the portfolio. And you can see here that the net debt to capital is 0. That means they have more cash than they have debt. That's a great thing. And their interest coverage ratio is 4,570, which they Simply Safe Dividend says, hey, anything above 8 is our preference. Well, 4,570 is a lot bigger than 8. So I think they're well covered on their debt. Now, the second stock I want to talk to you about that I added to the portfolio is Parker Hannifin. Parker Hannifin manufactures and sells motion and control technologies and systems for mobile, industrial, and aerospace markets worldwide. They have two segments, a diversified industrial and an aerospace systems segment. And you can see here that according to Simply Safe Dividends, they have a dividend safety score of 94. Their yield is a little bit low, but I'm okay with that when we look at some of the other numbers. They're at a 1.93% yield. Let's take a look at the dividend growth. You'll see that over the last 5 years, they've averaged 11%, which is pretty decent. Over the last 20 years, they've averaged 12%, and the latest growth was 29%. You can see that jump in this line right here. That's the 29% jump. So look at that dividend growth pattern up and to the right, just like we like it. And here's what's really cool, guys. Uninterrupted dividends for 66 years, and they have grown their dividends for 66 years. That, my friends, is hard to beat. Let's take a look at some of their financials. Their earnings payout ratio, again, is in the mid-20s, maybe rising to 29% next year. Their free cash flow payout ratio is also in the mid-20s. Very nice. I like it in that range. You can see earnings per share is moving up to the right. They are forecasting to be flat in earnings next year. But, you know, with the economy doing what it's doing, I think that's actually a pretty reasonable forecast. Moving on to the shares outstanding, you can see they have gone from 152 million shares in 2013 down to 130 million shares in 2022. Their sales are growing slightly. They have a return on invested capital of 14%, which is very respectable return on invested capital. I look for anything that's going to be a higher return than their cost of capital. Their net debt to capital is a bit high. It's in the 0.57 range, so they're 57% debt. But if you look at their interest coverage ratio, it's an 11.9 versus an 8 as kind of a floor. So I think they're well positioned to cover their debt load. Let's take a look at the entry point on fast graphs. You can see here where that green dot is. That is the entry point. It's somewhere around the 15 times earnings. So the third stock that I've added to the portfolio is T. Rowe Price. T. Rowe Price has a dividend safety score of 94. They have a dividend yield of 4.01%, which is outstanding for a growth stock. Many of you already know this, but T. Rowe Price Group is a publicly owned investment manager. The firm provides its services to individuals, institutional investors, retirement plans, financial intermediaries, and institutions. You will see here that the dividend growth over the last 5 years is a 15%. It's consistent with the last 20 years, which was 14%. And in February of 22, the board raised the dividend by 11%. So you can see the trend here on dividend growth is really phenomenal, really great trend. Let's look at some of the financials. Their earnings payout ratio is gonna spike here because their earnings are gonna be down. But I'm not afraid of that because I know why their earnings are down, and I do believe that long term, they will overcome this and the market will return and they will have their revenues back. Their free cash flow payout ratio is about 33%, so that's actually pretty good. Looking at their earnings per share, those earnings per share are going to be declining off of what we see in 2021. And if you look at this is pretty similar to what you see with the market. So their earnings will flow similarly, I believe, to what the market is going to produce. Let's take a look at their shares. They had 261 million back in 2012, and they actually issued some shares in 13 and 14, and then since then they have come down to 228 million. Their sales, you can see, are up and to the right, but they don't put the forecast in here. I would imagine those forecasted sales are going to be lower. Return on invested capital, 33%. That is phenomenal. I'm excited to add this level of return on invested capital to the portfolio. Let's look at one other thing, which is their net debt to capital. It is 0. That means they have more cash than they have debt. And their interest coverage ratio is negligible, meaning that they don't have any debt really to repay. So there is nothing to show here. So let's take a look then at the buy point for T. Rowe Price. So if you see this buy point is around, what would that be? About a 12.2 PE. The price was $120.25. So you can see that this is below the line here on Fast Graphs. I think this is a good place to enter T. Rowe Price. Obviously, would love to have had some back here when it was like 10.6 or even 10. But at the end of the day, I'm excited about 12 as well. So I also added some shares to Stanley Black & Decker. I know that's not a shock to many of you. I did say that if it went down to the low 90s again, I would add to the position. I bought 50 more shares of that. So I want to share with you just a chart here of what I see as the price versus the intrinsic value of these shares. So take a look at this. So you can see here that on Friday, I did these 4 transactions. I bought Stanley Black & Decker at $91.32. I bought Robert Half International, RHI, at $78.44. I bought Parker Hannifin, ticker symbol PH, for $279.85. And I bought T. Rowe Price, ticker symbol TROW, for $120.25. And when I look at Morningstar's calculation of intrinsic value, I see that they have calculated Stanley Black & Decker at 140. I'm not sure I agree with the 140, but you know, what if they're $40 wrong? I'm still at a discount of 10%. So I think Stanley Black & Decker is a good buy in the low 90s. And when I look at Robert Half International, they have an $88 intrinsic value for them. That's about 11 percentage point discount. And then I look at Parker Hannifin, it's valued at $325. There's a 14% discount there, and T. Rowe Price is about 11% discount. So the shares that I added, I'm really excited about. Not only are they good quality stocks that are going to be good for my portfolio for the long term, but I believe I'm getting them at a discount. So let's take a look at the dividend growth portfolio and see what impact these purchases had on it. Okay, so if I look at the top here, I see the annual income. This is annual dividend income that the portfolio is producing. Before I did the transactions, it was $15,040 per year in dividends. Now, after these purchases, it is $15,786. So I improved the annual dividend income by about $746. Then when I look at yield on cost, it moved from 2.81% to 2.82%. It's not a huge move, but at the end of the day, it's better than it going down, right? And so I also increased the dividend growth from 10.5% to 10.6% over a 5-year period. So I improved the annual income, I improved the yield on cost, and I improved the dividend growth. It doesn't get much better than that. So let's move on to the income, the dividend income portfolio. I sold out of a position there. I want to tell you about that. I sold out of New Jersey Resources. It's a regulated gas utility up in New Jersey. I had purchased that with the intent of selling and buying options against that. But I found out that in that process, they were very thinly traded in the options realm. And I could really never predict where their option prices were going to go. Also, their dividend yield had gone down because the share price had gone up. Their dividend yield had gone down to the low 3% range. And for my dividend income account, that was a little bit low for what I'm looking for in there. And the fact that I was also up about 15% on those shares, I went ahead and liquidated that position. And I used those proceeds to add to 3 other positions that were already existing in the dividend income account. Let's take a look at those. You'll see here I added positions, or I added shares to Best Buy, to Whirlpool, and to Altria. So I'm seeing Best Buy at a 34% discount. I'm seeing Whirlpool at a 27% discount. And I'm seeing Altria Group at an 11% discount. So I went ahead and bought shares into all of these, and it really had a interesting impact on the portfolio. Let's take a look at that now. You can see that the upper box here is before the transactions on Friday. The lower box is after the transactions on Friday. Annual income went from $16,044 to $16,420. So added about $376 per year to my dividend income portfolio, and really didn't change the value of the portfolio hardly at all. You can see here that the yield on cost went from 5.43% to a whopping 5.5%. I'm excited about that. My goal for this account is 4%. So 5.5% is really, really cool. And you can also see that doing the transactions that I did had actually a positive impact on the 5-year dividend growth. It went from 6.2% to 6.3% per year over a 5-year period. So the portfolio not only grew in dividend income, it grew in yield on cost, and it also grew in a 5-year CAGR. It just doesn't get any better than that. So I'm excited about what I did Friday in the portfolio, excited to share that with you. And I'm gonna share one more slide with you that shows just a summary of the shares that I bought and sold. I will actually update all of the transactions for the whole month in next week's video, but I wanted to share what I did on Friday because this is a lot more activity than I normally have in a given week, or actually 2 months as opposed to 1 week. So I wanted to kind of walk through what I did, why I did it. Again, the purpose of this video and the purpose of this channel is to just be transparent. So I'm sharing everything that I can with you. And I look forward to your questions, actually. So if you have questions about anything that I did, you can agree, you can disagree. I don't really care, because at the end of the day, it's my portfolio and I'm making the decisions. But I do like to hear your feedback, because sometimes it actually makes me think about things differently. So if you got any comments about any of these transactions, leave them in the notes below. I would love to hear from you. So here's the slide with the purchases. You can see that I bought 120 shares of Altria. I bought 5 shares of Best Buy and 25 shares of Whirlpool. In the yield, I call it the yield account here. It's actually the income account. And then I bought 50 shares of RHI, Robert Half. I bought 75 shares of TROW Price, 50 more shares of Stanley Black & Decker. I have some room to add more shares to that if I want. And then I added 25 shares of Parker Hannifin. And you'll see down here at the bottom that I actually sold New Jersey Resources, NJR, all 100 shares of that. So it was a big week, and I am excited to share all of this with you. Again, if you have any questions or comments, leave them below. I'm not an investment professional, so do your own due diligence. I'm just sharing with you my journey so that you can either learn from it or choose not to learn from it. And either way, it's okay with me. And guys, I think that's all I have for today. I will see you on the next video.